to put it on the record, I have to repeat some of what she just said. So we're now on the record in the Office of Tax Appeals, oral hearing for the appeal of Robert Victor Mirolla, case number 1801-1851. We are in Los Angeles, California. The date is Wednesday, September 18th, 2019, and it's 11:16. My name is Jeff Angija. I'm the lead administrative law judge for this hearing. My fellow co-panelists today are Andrew Quee and Win Dang.
Morning.
And for appellant, could you please introduce yourself for the record?
Dave Bowman.
And for CDTFA?
Minjung for CDTFA.
Monica Silva for CDTFA.
And Lisa Renati for CDTFA.
All right. And we were asked during the break to remind people to speak slowly. I think I'm the biggest offender of that, so I think they're talking to me, but I'll pass it on to you guys so that we can make sure that we're not outpacing the court reporter. We have 4 issues in this appeal, which are whether the notice of determination issued to appellant was timely, whether appellant is liable under Revenue and Taxation Code Section 6829 for the unpaid liabilities of Associated of Los Angeles, Inc. 3, whether the relief of penalties asserted against the acronym for the corporation, ALA, whether relief of those penalties is warranted. And last, whether relief of interest is warranted. And then during our pre-hearing conferences, the parties agreed to the admission into evidence of appellant's exhibits 1 through 5, CDTFA's exhibits A through D. Neither party had any objection to the admission of those exhibits. I believe that's still correct. Please tell me if it's not. And then we received an additional exhibit from appellant that we're proposing to introduce as Exhibit 6. I don't think there's an objection. It relates to the amount that's currently outstanding. I'm hoping CDTFA can explain whatever the actual amount outstanding is. It's a collection issue. It doesn't really affect the legal issue. So I know that it's relevant, but it's not something that's going to factor into the issues before us. But we would be admitting that evidence if CDTFA has no objection to that exhibit. And I would like it explained before we leave here what the actual amount due is. Because there's a discrepancy between that Exhibit 6 and what you guys show by a few thousand that I couldn't figure out.
We have no objection to the admission of the evidence.
Okay, so we'll have that as Exhibit 6.
But with respect to discussion about the liability, we're still in the process of trying to determine the exact amount as of this time. But we definitely acknowledge that the notice of determination is the higher amount, that there have been adjustments, and so we definitely know that the notice of determination is not the amount right now. But given some system issues that we have at CDTFA, we were not able to come up with the exact amount today, but we are in the process of making that determination.
Okay. And I know you could contact them at any point to get the exact figure, but again, we don't need it today to be able to resolve what we need to do. Okay, so I will admit Exhibits A through D and appellants 1 through 6 into evidence. And then based on our pre-hearing conference and my September 9th order, we have no witness testimony for today. I believe that's still correct. And so as we agreed, we'll begin with appellant's testimony and argument, which should not exceed 30 minutes. CDTFA can then ask questions if they wish, as can the panel. CDTFA will then make its presentation not to exceed 20 minutes, and appellant or the judges can ask questions, and then appellant gets a 5-minute rebuttal. And then I'll read this into the record. There were certain stipulations that the parties had reached in our pre-hearing conference. First was that ALA began doing business in California in January 1968. Second was that ALA filed for bankruptcy protection under Chapter 11 on April 2nd, 2010. Third was that ALA filed a sales and use tax return for the 3rd quarter of 2010 on September 1st, 2010, which it marked as final. Fourth is that ALA collected sales tax reimbursement on all of its retail sales of tangible personal property during the audit period. And fifth is that appellant was the person responsible for ALA's sales and use tax compliance during the audit period, which is not a conclusion that he's liable under Section 6829. That specifically relates to Element 3, and I know I explained that during the pre-hearing conference. Is that correct, what I've read? Was that list of 5? Okay, so those were stipulations. Okay, with that, I'd like to turn it over to Mr. Bowman and let you have your presentation.
Good
morning. Okay, just a brief timeline of what brought us to this point. Mr. Mirolla bought the company Associated of Los Angeles in 2005, and the company was located in Los Angeles, and they occupied a building that he had owned, and the company was renting it from him. They were a distributor of electronic components. During this time, they had a very large City of Los Angeles contract, and the significance of that is that it consumed a lot of resources, that the company had a very low margin on this contract, and they were bound by the contract all the way through bankruptcy to come due on that as far as purchasing additional inventory even after the bankruptcy filing to continue that contract. Money became tight, and then in January 2010 they decided to file bankruptcy. April 2nd is the filing date for the bankruptcy, and starting in the second quarter of 2009 they started getting behind on their sales tax. The sales tax returns were filed. They were all filed timely, and the sales tax, they were getting estimates, payments made, but they did not pay all the sales tax. February of 2010, they entered into a installment agreement, and that was $10,000 a week, and that ceased right before they filed bankruptcy. One note during this timeline is that some of the money that came in after bankruptcy was the recapture of the 90-day payments prior to the filing of the bankruptcy. So not all the money that came into the bank account were a result of accounts receivable or sales. And then finally, one of the biggest things is that June 4th, 2010, a competitor bought the assets, and the assets were defined as inventory and accounts receivable. And I'll talk a little bit more about that under willfulness. As we all know, and I'll just repeat this for the sake of repeating it, section 17025, there's three parts to the willfulness. There's knowledge, there's authority, and there's funds available. And we're not disputing at all the knowledge. Mr. Mirolla had the knowledge, of course. He was running the business, and he was responsible for making those. However, we are contending that he did have quite a few issues with authority and then the funds available once the bankruptcy started. And this was a huge issue for him because he kept being told that the sales tax would get paid, and it was like close to $464,000, I believe. And the bankruptcy team kept telling him, don't worry about it, it'll get paid, it'll get paid. Of course, at that time, he had no idea of what the ramifications of that were that brings us to today. And the other issue is the notice of determination. And on the notice of determination, we contend that it was not timely filed, and the reason for that was because on Exhibit C, page 37, the Chapter 11 case status report, the court date was June 9th, 2010. It describes Mr. Mirolla's immediate goal to keep the doors open until the sale can be consummated, thereby capturing the going concern value for the creditors of the estate. This document is in the CDTFA's exhibits, and we're trying to demonstrate that not all of these things, or not one of these things by themselves can stand on their own, but when we look at all of these things as a whole, that the notice of determination, in our opinion, just doesn't hold, and it really should have been the prior quarter that the notice of determination should have been issued. The second item is that the 6829 does not mention that written notice is required for a termination of a corporation. And the reason we're bringing that up is because this has come up before in a couple of the appeals cases, that the notice to the Board of Equalization at that time was given to them when they received the September 2010 sales tax return, and it was handwritten on the top and it said final. And this is also in the call logs that the Board of Equalization agent received this as the final sales tax return. However, we're contending that that's not the actual notice, and that the corporation really ceased in June of 2010 when it sold all its assets to Stevens Engineering, which is a competitor. So it is our belief, and as a CPA, that I see companies all the time, and I'm out there with them and I work with them. If a company sells all their assets, their accounts receivable and their inventory, they're done. It's a sinking ship, and it's just a matter of time that they're going to be closing their doors. Chapter 11 doesn't define that as the final liquidation of the corporation, because obviously the Chapter 11 is to try to reorganize them. But during that process of Chapter 11, the bankruptcy attorney was trying to bring and sell assets to pay off all the debts. So as a result, the company did sell the assets. The sale agreement was right around 1.2 million. There was a lot of stipulations in the sale agreement, so it ended up around 664,000. And that particular amount, we can't trace that exact amount, but we can trace the 567,000, which I'll talk about in the willfulness. Under notice of determination, under the phone calls on Exhibit C, page 404 and page 406, the Board of Equalization was given notice that there was a bankruptcy, and in the phone calls it clearly says that the agent didn't get the bankruptcy documents from the taxpayer. They actually went on Pacer and got it from Pacer. So she was very active with it. The Board of Equalization agent, when you look at these calls, was very good, and she did a really good job documenting everything. And in our Exhibit 5, page 7 of 19, this is not in the CDTFA exhibits, but this is where it describes that the BK information was retrieved from the Pacer. So we're contending under the notice of determination that not any one of these items is going to be able to prove that the notice of determination was deficient in its timeliness, but we are saying that taken as a whole, all these items and the facts and circumstances, that we believe it should have been the prior quarter. So therefore, the notice of determination would be invalid. Next is the willfulness, which we all know that this is a real tough one. The code is pretty clear as to the issues with willfulness and what has to happen or doesn't have to happen. Going back to the three, under 1702, the three requirements is knowledge, authority, and funds available. Mr. Mirolla pretty much lost all his authority when the bankruptcy started. He was under the direction of the trustee and the bankruptcy attorney as to what needed to be paid, and as for those of us who have ever gone through a bankruptcy with a company, there's a very detailed monthly report that is presented by the trustee accounting, and it details out every dollar in, every dollar out, and CDTFA has those reports in their exhibits as examples, and these clearly show that this company is just not gonna make it. Going back to the sale agreement, we retrieved from the attorney's invoices that they actually received $567,381. That was from Stevens Engineering, and there was about another $100,000 that came in sometime between August and October of that 2010. But clearly, I put the dates on the summary of all the payments that were received in. Now, my point is that Mr. Mirolla had no idea that this money came in. I mean, he didn't see it. It did not go in the DIP accounts. It went straight to the trustee and the bankruptcy attorney, and the money was used to disperse from there. So from August 2nd on, his ability and his availability of the funds was completely limited as far as trying to get the sales tax paid. And the sales tax balance is on all these monthly reports. It's right at the bottom. It shows the tax that's supposed to be due, but he was never instructed to make these payments and get this tax paid. Letter number C, total receipts of cash, April through August. I didn't mean this to be a fill-in-the-blank exercise, but my point of showing that is that we didn't put the total there. But the point is there was 124,000, rounded off, $124,400 received in from April to August on the receivables. So there really wasn't that much money that was coming in from the receivables. And on the August report, the receivables are gone. And the receivables are gone because Stevens Engineering bought those. So therefore, that was pretty much the end of all the cash. And again, during that time, Mr. Mirolla and his team, they paid payroll taxes, they paid the employees to finish off and shut the company down. That was their job. That's what they needed to do, is finish up and close everything down and finish the LA contract. Another issue toward not willfulness is that the phone calls to the BOE show a continued and genuine concern for the sales tax. They never ducked phone calls. Mr. Mirolla's son, Darren, always answered the calls and always got back to her, to the board representative when he said he was going to. And also in Exhibit 5, page 11 of 19, it shows in the call logs that the agent asked if there should be an audit on the company, and the response was no, because they have such a good track record in prior years. So one thing that was concerning that we did a lot of research on to find out what was going on. So my biggest question was why wouldn't this sales tax get paid when the money is there? I mean, what was preventing that from happening? So I contacted a good bankruptcy attorney and asked him, and then he asked the trustee. And what we discovered was that during the bankruptcy process, it appears that the BOE only put in a proof of claim for $76,000 and $71,000, and they got paid for that $76,000 and $71,000. So, from my understanding, the deal is that if the proof of claim is not in for the full amount, then the trustee and the bankruptcy attorney, they're not compelled to pay out the rest of the sales tax and get it paid. So it just kind of sits on the back burner. And also, unfortunately, Mr. Mirolla got stuck hanging with the bill because the money was there. They got all $660,000 of cash in, and the money just did not get paid to the Board of Equalization. So he was very, very upset about it, and he kept asking why they aren't getting paid, and he was told, don't worry about it. So the next issue is whether the relief of penalties asserted against ALA is warranted, and then of course the interest that is goes along with that. We believe, and Mr. Mirolla believes, that 3 years after the bankruptcy, totally understand, we're they're okay with that. It doesn't have a problem with that as far as having the interest and penalties accrue. The issue is the remaining 6 years, that the 6 years it took us to get to here. And obviously, with the tremendous amount of backlogs and the amount of detail it takes to put one of these hearings together, I mean, I can see why it takes so long to get to here. Because it's a long process. I appealed this twice. One of the times I talked to Mr. Geary in June of 2017, who's now one of the judges. So it's a very long process. And the issue is that the remaining 6 years, we're asking for relief on that under 1668G as to an unreasonable amount of time for the sales tax to be, I'm sorry, I think I just quoted that wrong.
6593.5.
There you go. Yes, very good. We're asking for relief on that because we feel that it's just been an incredible amount of time to get to here. And his question is why should I be charged penalties and interest? Because the process takes us a long time. It's not necessarily any employee of the BOE or the CDTFA. We understand that it's necessarily nobody's fault. It's just the fact that the process just takes a long time. So relief for those remaining 6 years is what we would really appreciate that the panel consider. And that is it.
I have one quick point for clarification. The penalties are separate from the interest, right? So the penalties are imposed for late payment, I guess late filing, I think it's late payment, during the audit period. So the 6 years, those are apples and oranges. The 6 years isn't relevant to the conduct that incurred the penalty. And in order to relieve those penalties under 6592, we need to hear a reasonable cause, a non-negligent reason for why the corporation failed to timely pay. So the 6 years doesn't pertain to that. I don't know if you want to separately address the penalties, but I just wanted to make clear that with what you've said is fine as it relates to the interest, but it doesn't give us a basis to consider relief of a penalty.
Okay, during the 2009 and 2010.
Right, and that's what we had discussed over the pre-hearing conference, is that the penalties were incurred by the corporation, so good cause needs to be shown for the corporation's failure to timely pay at that time when those payments were due.
Okay.
So, I just clarified.
Understood.
And I can allow time at the end if you want to address those specifically. Okay. But for now, does that conclude your
Yes.
case in chief? Okay, CDTF questions?
I did have one question on this, I guess get a clarification on the statute of limitations issue. When exactly are you saying that the business terminated? I think I heard June of 2010, but I'm just wondering what the specific date is and if you have a date.
Well, they vacated the building August 3rd, 2010.
Okay.
But as far as from June 24th or 20th to August 3rd, they were pretty much just handling all the remaining requirements for the LA contract. They were handling receivables that were still theirs until the sale closed. And so when they sell all their inventory and they sell all their assets, they were, as far as termination is concerned, as you know, the business is done. It's terminated. It doesn't have any assets to sell.
Okay, so if I'm understanding correctly, the date of termination is, from appellant's perspective, June 20th?
Yes.
Okay, and so I understand that they filed a return for the third quarter of 2010, which was July, August, September, and I'm wondering then what was reported, what sales were being reported on that return in the later quarter?
I don't remember if the September, I think the September did have a few sales because they sold some of the inventory that Stevens didn't pick up. I'm not 100% sure. So there were sales in July, but there was definitely no sales after August, about August 3rd. But there was some sales in July, I believe, because some of the inventory, they did pickups and they just sold it.
Okay, thank you.
Okay.
I had a question regarding the request for interest relief. The relief of interest in this case, the standard would be that there was some sort of unreasonable delay on the part of scheduling the appeals that you referred to that took 6 years. Obviously, the entire 6 years can't be deemed to be unreasonable. Is there some portion you felt that took longer than you might have expected, or you felt was unreasonable?
Well, unfortunately, I'm saying that 6 years is the
It does take time to arrange things, as you mentioned.
Right.
Yeah.
What I was saying is it's a total of 9 years, so we're saying the
Okay.
first 3 years, no problem, we totally understand it. But the last 6 years to today is just a matter of the process and how the whole process works. It's not anybody's fault. It just takes a long time to get here. Even some of these other cases, 2012, 2011, and we understand that, but he's just saying, why should he be charged interest for that? Because the settlement can't be done until we finish this and move forward.
As far as the time frame, what was it? When did the 6 years go back to? At what point was that the filing of the petition with CDTFA?
Well, he had filed the petition for appeal before he hired us, so I don't recall exactly what the date was on his appeal petition. So we didn't get involved until about 2014.
I guess I'm trying to understand where the 3 years, why the 3 years is reasonable, and then 6 years beyond that. Where was the transitioning point between 3 and 6 years? Was that still with CDTFA appeals? Were you in the audit process working with the district staff? Or had it already been, well, it couldn't have been petitioned before OTA because we didn't exist at that time, but was it petitioned before the board?
Yes, he had petitioned it before OTA came into existence, yes. I just don't remember what the date was.
Okay, thank you.
Can I try to clarify that?
Sure.
Based on what we discussed at the pre-hearing conferences, my recollection is that 3-year period is the difference between the termination date of the corporation and the date on which CDTFA issued the NOD to the individual, because it's 6 years from the date of approximately 6 years from the date of the NOD at issue here till today. The first 3 years is that they issued it sometime in 2013, and the corporation ceased in August of 2010.
Yeah, October 23rd, 2013 or 13. 13,
Oh,
Yeah.
That's when the NOD was issued.
So the 6 years is basically this.
Okay, great.
Yeah.
Thank you. I also have one other question regarding willfulness. I noticed you had mentioned in your presentation that it appears a dispute had arisen due to appellant lacking the authority to pay and the funds available once bankruptcy had started for the corporation. Prior to that period, there's no dispute that appellant had the authority to pay and funds were available?
Well,
Is bankruptcy the defining point in which he lost that ability?
yes,
Okay.
we're saying that up till the point of bankruptcy, Mr. Mirolla thought he had a chance. He thought, he met with the bankruptcy attorney in late 2019, or 2009, and the whole original plan was to put him through 11, have him come out on the other end, and he continues on, and he gets his paycheck every 2 weeks, and everything's fine. They lose some employees, and because the business was going down because of the recession, but they had no idea that things would hit so hard and so fast. As a result, he was thinking all along he was really going to be able to pay this back. And the call logs show that even in August or April 2010, Darren Mirolla was telling the agent that we believe that we can pay this. And he also said in those calls that once the business sells those assets, they'll get paid. Well, unfortunately, they didn't even see the money. The professional fees alone were almost $500,000. So a lot of the money was just gone. Unsecured creditors didn't get anything. That's the unfortunate part of the outcome of this. But yes, I mean, he felt that he was going to be able to turn this around and pay it. That was his intention, and it's in there until the May. That became very clear in May. It's in the one exhibit that I quoted, that his intention now was just to keep it going enough to pay off all the bills and sell the assets. So in May, it was a clear cutting point that that's when he knew it was done. There's no way this was going to go back.
Okay, thank you.
CDTFA?
Yes, thank you. First, respect to appellant's personal liability for the unpaid sales and use tax liabilities of Associated Los Angeles, we call it ALA. Revenue and Taxation Code Section 6829, Subdivision A provides that upon termination, dissolution, or abandonment of the business of a corporation, any person having control, supervision of, or who was charged with the responsibility for the filing of the returns or the payment of the tax, or who was under duty to act for the corporation in compliance with any requirement of the sales and use tax law, shall be personally liable for the corporation's unpaid tax, interest, and penalties if the person willfully failed to pay or caused to be paid any taxes due from the corporation. Under Section 6829 and its implementing regulation, 1702.5, 4 requirements must be made to hold a person personally liable for the unpaid tax, interest, and penalties owed by a corporation. First, the corporation's business has terminated. Second, the corporation collected sales tax reimbursements, as relevant here. Third, the person was a responsible person. And fourth, the person willfully failed to pay or caused to be paid the corporation's tax liabilities. Here, appellant has previously considered the first 3 of the 4 requirements for imposing responsible person liability, which are also established by the department's hearing Exhibit C, the dual package. That leaves only the last requirement in dispute, whether appellant willfully failed to pay or caused to be paid any tax due from AOA. Revenue and Taxation Code Section 6829, Subdivision D defines willfully fails to pay or caused to be paid to mean that the failure was a result of an intentional, conscious, and voluntary course of action. Regulation 1702.5b2 provides that a person has willfully failed to pay taxes or caused them to be paid, or he or she knew that the taxes were due but not being paid, had the authority to pay taxes or caused them to be paid, and had the authority to pay the taxes but failed to do so. Regulation 1702.5 further explains that this failure may be willful even if it was not done with a bad purpose or evil motive. The first element for willfulness is knowledge that the taxes were due but not being paid. We just heard from the appellant that appellant does not deny knowledge, and of course the department has abundant evidence to establish to establish the knowledge element as well. But for the economy of time, I'll skip those. So we're going to the second element for willfulness. The authority to pay the taxes or to cause them to be paid. On that, appellant as ALA's president and CEO and sole member of its board of directors and sole 100% stockholder had authority over ALA's financial matters. And as the exhibitor, the dual package exhibit shows, appellant admitted that he was responsible for ALA's sales and use tax compliance. In addition, in a written agreement dated February 11, 2010, appellant certified that he had the authority to request an electronic debit from the corporate account. In other words, he had the authority to pay. Furthermore, in the department's hearing Exhibit D, Darren Mirolla stated that only appellant could authorize payments, and the appellant confirmed in the same writing that that statement is true. So the authority to pay element is also satisfied. The last element for willfulness is the ability to pay taxes. In other words, whether AOA had funds available to pay the taxes. The department's evidence establishes that ALA did have funds available to pay the taxes, as during the liability period, ALA collected sales tax reimbursements on its sales, as shown in dual package exhibits D, E, F, and I3. And further, ALA had funds available as summarized in the dual memo on page 5, with evidence from ALA's financial documents and its substantial payments of wages and rents as provided in dual package exhibits I through R. For example, dual package exhibit O, ALA's October 09 bank statement, shows deposits of over $1.3 million with an ending balance of over $281,000 on October 30th of 09. That's right around when the second quarter 09 tax return was due. Then dual package exhibit P, ALA's operating statements for 09 as of October 31st of 09, shows year-to-date sales of over $6 million, cost of goods sold of close to $5 million. Then dual package exhibit R, the EDD inquiry, shows that ALA paid over $1 million in wages for second quarter 09 through fourth quarter of 09, and then more than $500,000 for the first 3 quarters of 2010. Dual packages exhibit I through I3 further contains various bankruptcy filings documenting ALA's financial status and payments. For example, for first quarter of 2010, the 90-day period right before ALA filed for bankruptcy, ALA paid over 30 vendors over $500,000. That's in our hearing exhibit C, pages 56 to 58. And then ALA's total disbursements were over $544,000 for second quarter of 2010 and $328,000 for third quarter of 2010. Those payments included payments of over $20,000 a month post-petition on insider compensation, including about $7,000 to $8,000 a month to appellant each month, as well as rents payable to the Mirolla Family Trust of about $25,000 per month. Those same documents show that cumulatively, ALA had gross sales of over $662,000 post its bankruptcy petition. You can find those numbers in our hearing exhibit C, pages 235, pages 92 to 93, pages 119 to 120, and pages 147 to 148. Further, a statement of cash receipts and disbursements for April 2010 for a general account shows a beginning balance of over $179,000, and bank deposits were over $240,000 into one bankruptcy checking account for the first 20 days of April 2010, over $180,000 into ALA's business checking account for the first 20 days of April, and over $74,000 for another bankruptcy checking account for the last 2 weeks of April 2010. You can find those numbers in our hearing exhibit C, pages 71, 74, 76, and 82 respectively. So those numbers were right at the time when ALA filed for bankruptcy. So the funds moving over into the bankruptcy accounts. So this and all the other evidence included in the dual package establishes that ALA had funds available, including the sales tax reimbursements collected for appellant to pay or cost to be paid in full ALA's self-reported tax liabilities, when the appellant had actual knowledge of them due but unpaid. But the appellant instead chose to use the funds to pay other vendors, rents, wages, including wages to himself, and other operating expenses. Therefore, the authority to pay element is satisfied as well. In sum, the evidence established that appellant knew the taxes at issue were not paid on or after the date that they became due, had the authority to pay or cause them to be paid on the date that the taxes became due, and when he had actual knowledge of the unpaid taxes due. And ALA had the ability to pay with ALA's funds available when the appellant had the actual knowledge of the unpaid taxes due, yet the appellant chose to use all the available funds, including tax reimbursements AOA collected from customers for other purposes, including paying himself and the family trust for rent, and failed to pay or cause to be paid AOS taxes. Together, these three elements establish appellant willfulness under Section 68-29 and Regulation 1702.5. Appellant's argument that he did his best he could due to the economic situation and intended to pull the company out of distress first before paying the department is legally irrelevant. The fact remains that even by the appellant's own account, appellant made an intentional, conscious, and voluntary choice to pay others first before paying the department. Such an intentional, conscious, and voluntary choice to pay others first before the department, while appellant was a responsible person and had the authority and ability to pay the taxes he knew were due and unpaid, falls under the very definition of willfully fails to pay or cause to be paid under Section 68-29 and Regulation 1702.5. And the appellant's argument that his authority and ability to pay was limited upon bankruptcy filing was incorrect for the periods at issue. First, there's no trustee in control in AOS bankruptcy case, as this was a Chapter 11 debtor in possession situation, both legally and factually. So legally, under the bankruptcy code, upon filing of a voluntary petition for relief under Chapter 11, as was the case here, the debtor automatically assumes additional identity as the debtor in possession. That's U.S. Code Chapter 11, Section 1101. That term, debtor in possession, returns the debtor that keeps possession and control of his assets while undergoing a reorganization under Chapter 11 without the appointment of a case trustee. As the debtor in possession, not only did the AOA have the authority, in fact, it had the obligation to pay all necessary taxes. Factually, when you look at all the bankruptcy documents on file, Exhibit C, for example, page 36, the Chapter 11 case status report, the top says, attorney for debtor in possession, and then all the form questionnaires that appellant completed for the corporation were phrased from the debtor in possession perspective. So like, has the debtor in possession done this in the last 30 days, done that in the last 30 days? So everything shows that AOA was in the debtor in possession while it was in Chapter 11 bankruptcy and had control of its corporation, including its assets and payments.
And what page was that? I'm sorry. Exhibit.
Exhibit C, for example, I didn't get all the references. There were like 30, 40 references to the debtor in possession. Page 36, okay. For example, that's a case status report. And when you look at the questionnaire, I didn't get all the page references. One of the documents appellant signed and the printed capacity of principal for debtor in possession, that was in Exhibit C, page 96. So all of this show AOA was the debtor in possession and control. There was no case trustee. You may come across reference to a bankruptcy trustee, but that's a United States trustee. So that's a totally different entity from the case trustee or the debtor in possession. So basically, regardless of who had control, whether it's a debtor in possession had control or it's a case trustee had control, there's always in the background an oversight organization that was housed at the Department of Justice. It's called the Office of the U.S. Trustee. They don't have control, they don't get actively involved in the bankruptcy at all. All they do is when you gotta copy them, all the documents in file. I mean, the appellant had to copy the U.S. trustee, all the documents in file, and they just monitor them to make sure there was no fraud and nothing out of the ordinary. But that was the case even if there was a case trustee, which was not the case here. So there was no inability to pay as the taxes continued to accrue post-petition. Granted, there was some restriction post-petition to pay pre-petition dates. But when you look at all the quotas at issue, second quarter of 09, and then fourth quarter of 09. Those were pre-petition periods. The knowledge of the taxes due for the petition periods were there, and the appellant didn't deny. On the due date, all the way through the date of the bankruptcy filing, the authority to pay and the ability to pay were also there, all the way from the due date of those taxes, all the way through when they filed for the bankruptcy. So they had the appellant had all the time from the due date all the way through the date of the filing of the bankruptcy to take care of those taxes, but he failed to do that, satisfying all the three elements: knowledge, authority, and ability to pay during those periods. And that's sufficient for the imposition of the responsible personal liability under Section 6829. And in fact, when you look at the case law, we had cases where a former officer who quit before the corporation was terminated could be held liable for the period. He had knowledge, authority, and ability to pay. So there's no reason why when the appellant, who actually continued to have responsibility, would not be held liable once the bankruptcy filed. He had all these time periods to do that, and under Section 6829, that was sufficient for that. And in terms of the post-petition liability, as I said, as a debt imposition, not only did the AOA have the authority, but in fact had the responsibility to pay all the necessary tax as accrued. So, and in fact, when you look at all the bankruptcy financial documents, AOA did pay vendors, pay inside compensation, including appellant himself, pay the rent to the family trust. All these payments show AOA could make payments, and of course, appellant as a principal for the debt imposition and continuously as a CEO president, sole 100% owner, and sole director, had all the authority and ability to make that happen. He just, and as appellant just made reference to a May 2010 event, that was in their mind the defining moment when the appellant knew they could not make it. But even by that account, they had the ability to make all the payments. They just decided from May of 2010 onwards that they should pay others first to make the business afloat instead of paying the BOE. That again is a conscious, voluntary choice, and that would make the very definition of willfully failed to pay or cost to be paid, and Section 6829. So accordingly, the department has made its burden of proving all the elements required for imposing personal liability on appellant for the unpaid liabilities at issue here. And the bankruptcy, the only thing, if I pointed out, the only thing the bankruptcy could have impacted on is the first quarter of 2010 liability, which was for pre-petition period, but that came due post-petition. But as you can see from the DNR, the department deleted that quarter from the responsible personal liability against appellant. So that was the only narrow impacted quarter, which was not an issue. Now, turning to the issue of timeliness of the notice of determination. As you know, a notice of a deficiency determination issued under Section 6829 shall be mailed as relevant here within 3 years after the last day of the calendar month following the quarterly period in which the department obtains actual knowledge of the termination, dissolution, or abandonment of the business of a corporation.
Slow down a little bit for the corporate.
Oh, thank you. As a matter of law, the period in which the timely issue a notice of determination under Section 6829 cannot start until the corporation had actually ceased its business operations. Here, as set forth in the department's dual package, Exhibit M, that was the last page, which was also in appellant's Exhibit 5. ALA's last day of its business operation was August the 3rd, 2010, according to its Vice President, Darren Mirolla. And the appellant does not, I guess, well, now the appellant disputes that. But regardless, the evidence established that ALA continued to operate past April 2010, making substantial inventory purchases and sales, continue to file returns for first quarter 2010, second quarter 2010, and third quarter 2010, as debtor in possession, reporting considerable sales tax liabilities, and continue to pay wages to many employees, all while under Chapter 11 reorganization bankruptcy, all the way through August 2010, as evidenced by the bankruptcy financial documents showing sales ALA made post-April 2010, as well as ALS sales and use tax returns and EDD wage payments. And just today, appellant made a new argument about a new knowledge date for June 2010, the asset sales date. But that goes the same. That actually contradicts the evidence the department has. For example, dual package Exhibit R shows that ALA had 43 employees in June 2010, 17 employees in second quarter 2010, of course that included June, and then 11 employees in third quarter of 2010, that's post-June 2010. And paid wages of over $500,000, and there were about $19,000 for third quarter of 2010. Of course, that's just basically just 1 month and 3 days. But that was still a significant operation post-June. Then dual package Exhibit J of the hearing Exhibit C shows that the LA reported a total sales of close to $593,000 for second quarter of 2010, and then $85,000 for 2010, for third quarter of 2010. As documented in the ACM notes, included the department's dual package Exhibit N. Because ALA's third quarter 10 sales and use tax return had a handwritten notation final, it prompted the CDTF staff to make a phone inquiry on September the 10th, 2010, to inquire what final meant on top of the third quarter 2010 return. To which ALA's Vice President, Darren Mirolla, said, I quote, "The business doesn't exist anymore." I asked him what date the business closed, and Darren said, August the 3rd. We'll forward to TDC we'll forward the request to TDC for closeout, end quote. This clearly establishes that ALA did not terminate its business until August 2010, and further, the department did not learn about the business termination until from Mr. Darren Mirolla via the September 10, 2010 phone conversation, basically with both ALA's business termination date and the date of the department's first knowledge of it in the third quarter of 2010. 3 years after the last date of the calendar months following the quarterly period of third quarter 2010 is October 31st of 2013. Therefore, the NOD dated before that on October 28th, 2013 is timely. The above evidence I just pointed out also contradicts appellant's new argument today that ALS business terminated upon its asset sales to Steve Engineering in June 2010. As you know, the law defines business termination to mean the termination of the operation for which a seller's permit is required. The fact that ALA continued to make sales, employing employees paying wages and reporting sales tax liabilities past June shows that the ALS operation, which required a seller's permit, continued all the way at least through August of 2010. Since ALA did not actually close until August 2010, the departments could not have had knowledge sooner than the actual termination date, either when it was filing for bankruptcy or when they sold a significant portion of its assets to Steve Engineering. Therefore, it's legally irrelevant whether a department knew prior to the date on which ALA actually terminated its business operation for which a seller's permit was required, that ALA was likely to terminate its business operation soon after its bankruptcy filing. The statute of limitation begins on the date of the department's knowledge of the actual termination of the business, not the likelihood of its business future termination, nor its sale of the assets if after that point of time it continued to make retail sales requiring the seller's permit. Respect to the third issue for the relief of penalties, LA was assessed penalties for its failure to timely file returns or pay taxes due for the periods at issue. and the department properly included those penalties in the NOD issued to appellant under section 6829. There's no statutory or regulatory authority for relieving penalties in section 6829 determinations. But section 6592 subdivision A provides that the department may relieve late payment penalties if it finds that the failure to timely pay was due to reasonable cause and circumstances beyond the person's control and occurred notwithstanding the exercise of ordinary care and in the absence of willful neglect. Thus, if reasonable cause is shown why LLA failed to timely pay its taxes, the penalties incurred by LLA may be relieved, and consequently, appellant's liability for the penalties would also be eliminated. Here, appellant just states that LLA was a victim of a severe downturn in the economy, that it did everything could to pay the taxes and keep the business alive. However, a lack of funds, whether due to economic recession or other reason, does not constitute reasonable cause or circumstances beyond the corporation's control sufficient to relieve the penalties. Moreover, as I discussed in detail previously, the department's evidence established that ALA did have funds available to pay the taxes. Therefore, no relief of the penalties is warranted. Lastly, on appellant's request for interest relief, the imposition of the interest is mandatory. The law provides for relief of interest only under very narrow circumstances. The only possible basis for relief here would be unreasonable delay by a CDTFA employee. Our appellant does not state any fact that suggests there was, and we are not aware of any such unreasonable delay. Therefore, no relief from interest is warranted. In conclusion, the responsible person liability against the appellant here should be sustained because the department issued the NOD within the 3-year statute of limitation and has further established all 4 legal requirements that are necessary for imposing responsible person liability, and the appellant has not provided any basis for relief of interest or penalties. This appeal should therefore be sustained. Thank you. Be denied, I'm sorry.
And that
Pardon me.
concludes, that concludes your presentation.
Yeah.
And a 5-minute rebuttal from Helen. Oh, sorry, questions?
Yeah. Go ahead. Just one very quick question for CDTFA. Under Revenue and Taxation Code Section 6950, I'm sorry, I'm getting this jumbled. 6593.5, the interest relief provision. I was just curious what CDTFA's position on the meaning of board employee. Does that include OTA, or is that limited only to CDTFA employees?
Yeah, it was referring to a CDTFA employee.
Okay. Go ahead.
Yes, your question was whether or not the interest relief applies to a CDTFA employee as written in the statute, correct?
Correct.
Right. So CDTFA.
Okay. Is there any authority for that position?
Yeah, I think the government code that split the BOE into 3 agencies basically said in terms of for anything other than constitutionally related functions that was reserved for BOE, every other references for BOE or board basically would be referring to CDTFA from the point onwards after the reorganization.
Thank you.
It says with respect to an appeal, it should be referred to OTA, correct?
Yeah, correct. I'm sorry, yes.
I did have a separate question. So I thought there was reference to an installment payment agreement. Was the installment payment agreement during the time frame of the liability period, or was that before the liability period?
It was, there was installment payment agreement entered on February, I believe that February 10th, 2010. That was to cover the 2nd quarter and 4th quarter for 2009 liability. So the appellant did attempt several payments, but one of the key terms of the IPA was that they had to file returns and make prepayments as an ongoing obligation. They did not make not only did they not make all the installment payments, they also failed to satisfy the ongoing obligation to file new returns and through prepayments as they became due.
So when was the installment payment agreement terminated?
I don't think there was a, like an official termination date. It's just because of the failure of the appellant to stick to the installment payment agreement, it was no longer in effect. And there was never any attempt by the appellant or LA to make further payments or make a good on that agreement afterwards anyway.
So CDTFA never officially sent a letter terminating the installment payment agreement?
I did not check into that because it was not pertinent from my perspective to the case. Because even without the IPA, after the IPA and all the way through the bankruptcy filing date, appellant could have made the payments and had the authority and ability to pay with all the three elements for willfulness satisfied. So regardless of whether he had some sort of good faith attempt at one point to satisfy the liability, the fact remained he did not satisfy all the obligations. And because he knew that, he had the ability and authority to pay those liabilities all the way up till the filing of the bankruptcy, he was still liable for the corporation's liabilities legally under Section 68 to 29.
So I guess I had thought that CDTFA generally didn't hold willfulness during the time frame that there was an active installment payment agreement until after the IPA was terminated. I'm not sure if that is.
We did have we did do that, but in this case, there was not compliance with the IPA.
Okay.
It's only when there's a full compliance with the IPA
Okay.
that we use that.
I see. And as far as the case being converted to a Chapter 7, did that occur during the liability period, or was that later? Do you know when the conversion was to Chapter 7?
That was, even for the documents filed all the way through 2011, that was still referring to LA as a debt imposition.
Okay.
Yeah, we don't have the exact date on when it was converted to Chapter 7 or when exactly the bankruptcy actually ended, but again, that was not pertinent, because all the way through the due date of the third quarter 2010 liability, which was the final period that was assessed against the appellant. Appellant had the knowledge, authority, and ability to pay, and since he did not pay, and had all the time to do that, whether, several years down the road, he couldn't pay, that was legally irrelevant under Section 68 to 29.
Okay, but then the Chapter 7 occurred after the liability period is.
Way after.
Okay.
We don't know exactly how many years after, but at least 2010, 2011, at least more than a year afterwards.
Okay, understood. Thank you.
Sorry to go back to this again. Under 6593.5 subdivision A, board is also referenced. I was just wondering CDTFA's position on whether board refers to OTA or the CDTFA in that subdivision.
We previously gave our position in another case, basically said whenever there was an appeal involved that dealt with interest or penalties, or wherever the statute referenced that the board employee may do that, since OTA stands in position of the board in terms of appeals function, CDTF's position is that OTA had the authority as well.
So we have the authority to relieve the interest, but in terms of the unreasonable error delay that gives rise to relief, that would pertain to actions by CDTFA.
Correct.
Okay,
Yeah.
thank you.
I have no further questions.
We never allowed you rebuttal, so I turn it over to you for a rebuttal.
Could you repeat that?
All that we just said there?
I'm just kidding. Just a couple things. We kind of knew the rent issue was going to come up, and I talked to Mr. Mirolla about this. And basically, he had said that about 16 to almost 18,000 of the 25,000 month rent, that was his mortgage on the building, and another 5,000 or 6,000 a month was for the property taxes that he had to pay on the building. So although it sounds like it's not a good idea to pay the rent to himself. They still had to occupy the building, and otherwise the building would have been foreclosed. So it's kind of a catch-22 they had to do with that. In August of 2010, I just looked it up, there were no sales in August of 2010. Unfortunately though, I did not catch there was sales in July. So, and that's about it.
Okay, you have nothing further?
No.
Questions from the panel? None? I think we have all the evidence, and with nothing further on the horizon, I will close the record and we'll end the hearing. The panel will confer after today, and we will issue a decision within 100 days. I hope we're faster than that, but the maximum allowed is 100 days, and that'll do it for today. So thank you everybody for your time and eloquence. Thank you.
Thank you.
Okay, good morning and welcome to the Office of Tax Appeals. My name is Andrew Kui, and to my left is Blake Geary, and to my right is Richard Tay. We are the administrative law judges who will be conducting this appeal for OTA. OTA is a separate agency from CDTFA, and our role is to conduct and decide this appeal. In a few minutes, we'll go on the record, and by on the record, I mean a certified shorthand reporter will transcribe what is said today, and that will be available on our website later on. The transcript will become a part of the record and will be viewable from our website. After we go on the record, I'll ask everyone to identify themselves and who they represent. For now, I just wanted to cover a couple of housekeeping matters. At the pre-hearing conference, I think Mark Hartman and Shannon Hartman were going to be the witnesses for the taxpayer. Is that correct?
Yes.
Okay. And I understand CDTFA has no witnesses. That's still correct. Okay. And on the exhibits, so quickly, last week I sent out an exhibit index. Did anyone not receive the exhibit index?
We didn't get an exhibit. Okay, I'm sorry.
Oh, okay. And see, yeah, well, these are your exhibits, so I assume you have them. And so basically, I have exhibits A through H for CDTFA, and I do not have a record of receiving exhibits for the taxpayer. Is that correct?
Correct.
Okay. So if there are no additional exhibits to add, does the taxpayer have any objections to admitting the CDTFA's exhibits into evidence?
No.
Okay, great. So when we go on the record, I'll admit the exhibits into the evidentiary record, and without objection, I'll ask the parties to confirm that's the case. And I think as far as the time estimates, what we're going to be doing is we'll start with the taxpayer's opening presentation. Since the taxpayers are witnesses, I'll swear them in before they testify. And after that, I'll move on to CDTFA's opening presentation.
Can I ask you a question?
Okay.
Why is it that we go first?
Oh, generally the party with the burden of proof goes first. That's the way we usually do these hearings. And then after that, each party will have 5 minutes for any rebuttal arguments they wish to raise. The panel might ask questions of the parties, and if you're testifying under oath, then CDTFA will also have an option to ask questions of the witnesses when they testify. Okay, so with that, I believe we're ready to proceed. Does anyone have any questions before we go on the record? Okay, let's go on the record then. We're opening the record in the appeal of Priscilla's Gourmet Coffee Inc. before the Office of Tax Appeals. The OTA case number is 1807-3393, and today's date is Wednesday, September 18th, 2019. Time is approximately 10:02 a.m., and the hearing is being convened in Los Angeles, California. For the record, will the parties at the table please state their names and they represent, starting with the representatives for the taxpayer. So let's go make up.
I'm Shannon Hartman. I'm from Priscilla's Coffee.
Mark Hartman, Priscilla's Coffee.
Sunny Paley for CDTFA.
Monica Silva for CDTFA.
And Lisa Renati for CDTFA.
Okay, great. So today's hearing is being heard by a panel of 3 administrative law judges. My name is Andrew Hui, and I am the lead judge. Judge Michael Geary to my left and Judge Richard Tay to my right are the other members of this tax appeals panel. All three of us will meet after the hearing and produce a written decision as equal participants. Although the lead judge, myself, will conduct the hearing, any judge on this panel may ask questions or otherwise participate to ensure that we have all the information needed to decide this appeal. The documentary evidence marked for identification in this appeal includes exhibits A through H for CDTFA and no exhibits for the taxpayer. There are no objections to admitting any of these exhibits into evidence. Will the parties confirm for the record that the summary I've just provided is correct and that they have no objections to admitting these exhibits into evidence, starting with the taxpayer?
Yes.
Okay, thank you.
Yes, correct.
Okay, thank you. So at this point, there is going to be one issue that we'll be deciding in this appeal, and the issue is whether the appellant correctly reported its sales and use tax liability during the audit period. And at this point, I believe we're ready to proceed with the taxpayer's opening presentation. Before you start, if you'd raise your right hand so I can swear you in. Do you swear or affirm to tell the truth, the whole truth, and nothing but the truth?
Yes.
Okay, thank you. You may proceed.
Well, the only thing I'm not sure about is how much of the case you guys already know. Do I need to go through the whole case from the start?
We're familiar with the documentation, the briefing that was provided to us, but
Okay.
Feel free to allocate your time and testimony however you wish.
All right, great. Well, we've been in business for 32 years now. We're a mom and pop coffee house. We started it with our own money just out of college. We only have the one location. We have one child, and we own our house. We are not multimillionaires. We are not spending the weekends in Vegas. We're not hiding money. We've been audited by the IRS with no issues. We've done nothing but try to be pillars of our community. We follow the rules and the laws of our state and our country. In retrospect and going back over everything that's happened in this case, there's not a single thing we could have or would have done differently than what we had done at the time and what we would up to this moment. All we've ever done is try to comply and follow the rules and the laws as been stated to us. I also like to note that we were in business for 20 years with no issue before this original, the beginning, which I guess they're apparently calling not an audit, which happened in 2011. We were approached and told that we were not charging sales tax correctly in 2011. We were charged and fined $5,000, which was levied out of our bank account with no warning. Consequently, we managed to get a meeting with Jerome Horton, who was at the time the head of the entire department, which has now changed names. And we conducted a meeting with him because we wanted to do everything exactly the correct way. In the entire meeting with us, with Jerome Horton and his entourage, it also included Betty Jo Ticoli, who was a representative of the Small Business Association. And the entire time in this meeting, what was very clear to everybody was it is not a cut and dry law, especially when it came to a coffee house, which was a newer business. We'd experienced it all along. We were pioneers in our industry, beginning with the health department and them having to discover and create new areas that would address our business and the type of business we had. So at the time in our meeting with Jerome, the entire purpose of that meeting was to figure out how to do and charge sales tax correctly. At the end of the meeting, we were told that they would get back to us. Consequently, in the subsequent days, my wife had conversations with members of Jerome Horton's staff, in which we were given advice on how to proceed with charging sales tax. Pardon me. By the way, at the time in this meeting, which is what we are being required to do and in complying currently, Jerome Horton said to us, the last thing he wanted us to do is have to ask every single customer for here to go, which is what we are doing now because that is the law and we are complying with the law. But that was coming from the head of the department. His thought was, and our contention was as well, there are other major corporations, including Starbucks, that do not ask for sales tax for here to go because they have created a deal where they are allowed to charge a percentage of sales. In discussing that with Jerome, he felt that that was probably the best way for us to go, and he would facilitate and work out a way for us to do that.
Can I have one thing? And one of the problems that we have is for here to go, what we always did was, when we said for here, it was in a mug on a plate. And to go meant a paper cup, they were taking it to go. So when we said that's how we always did it, so it became, when we explained to Jerome, it was one of those things where when we had somebody a paper cup, we were saying, well, do we have to say for here to go? And then they're taking the paper cup. It's like, okay, and when you have that paper cup, are you leaving? You know, like it was kind of, it was because we weren't like a Starbucks, they're all paper. And ours was, you know, for here always meant that you were sitting down with, you know, a plate and a fork and a knife and all that. So that's what even added more to it. Like it was confusing, and it just so that's how we understood it is, and that's how we always went by when you had to go, is that you were taking it away, you know.
So the thing that's a little bit frustrating for me as a business owner in trying to do the correct thing, and now fast forward to 2016 and being audited again and being told that from that period until 2016, from the time we met with Jerome Horton until 2016, we were once again in violation, despite our repeated attempts. And honestly, there's nothing else we could have done to do it any different. We went straight to the head of the department and had a meeting with him for nearly 2 hours to figure out how to charge the correct taxes. It's not a cut and dry law. However, in the subsequent audit or whatever this is now called, because you guys have your determinations, personally I felt we were audited. When you have a government agency look at your business, look at your records, fine you for something, to me that's an audit. And you can call it scope or you can call it whatever you want, but to me, in my experience, that's an audit.
The original one.
It says here in this documentation that we received, it's page 3 of the exhibits that we received. It says the taxpayer must establish by documentation or other evidence that the circumstances it asserts are more than likely to be correct. And the contention here continues to be is that we do not have anything in writing. Because petitioner has not been previously audited, which is what the contention, that 2011 thing was not an audit, petitioner did not request to receive any tax advice from this agency in writing. And that's the contention that I have now, and I guess is the apparent problem, is that if we had gotten something in writing on that day, we wouldn't be here today. And there is also the new law is that for us to sign and have I'm sorry, I'm not finding it right here. For us to sign and pay a percentage, there are certain requirements, including a minimum of 5 stores and signing of a certificate. I don't know why in 2011 we weren't told that. If it was a law then, and we're meeting with the head of the entire Board of Equalization, I don't understand why we're not being told or given these avenues or told you don't have 5 locations, you can't do this. But we were being told and complying directly from the advice of people we're trying to comply with. I don't understand why the statute says you have to have 5 or more stores. I don't understand what the difference is between whether having 5 stores, 4 stores, 2 stores, 1 store, 30 stores, whether or not that would justify you being allowed to pay a percentage and not have to constantly harass. We have 80% return sales to our store, and every day we ask the same person every day for here to go, for here to go, for here to go. Every day they come in. It doesn't make sense to me, but that's the law, and we're complying because that's all we've ever tried to do, and that's all we were trying to do during this period in question. There's nothing we could have done that would have been anything different. There's no way we could have taken any out. We thought we were in compliance. We did everything we could to be in compliance. So I'm not really sure what else we could have done We, to this day, now that we are apparently in compliance, still have nothing in writing that's saying we're in compliance to today. So 5 years from now, I don't know that I'm going to be right back in front of you gentlemen again. Hopefully I won't be, and doing the same thing, and they're telling me I don't have anything in writing. I have nothing in writing telling me I'm in compliance as of this moment. A final note, we were told that in 27 this was a scope evaluation, not an audit. We received a second scope evaluation just recently, completely different, had a checklist, they went through our stuff, they saw what we were doing, they said, yes, you're in compliance, they signed off on us. They gave us a card, we have a contact person. None of that happened in 2011. The only thing that happened in 2011 was they looked over our stuff and took the money directly. We woke up the next morning and our bank account was empty. It was taken out. And then from that moment on, we were fighting and trying to try to get the money back, which we never did. We ended up paying the fine. But we met with the head of the board, and once again, I keep saying this, but I don't know what we could have done differently. I don't know how we could have conducted different business. We don't know what it's not like we weren't trying to do the right thing. It wasn't like we were sticking our head in the sand and not trying to understand what the laws were. We went to the head of the department and got advice directly from them. And the only thing in here that tells me that I didn't do anything right is I didn't get it in writing. And I have a certain expectation that when I'm dealing with a government agency, that what I'm getting the advice from them is the law. And I didn't understand or didn't realize that I would have to have in writing from a government agency informing me how to conform to their laws, that agency's laws. I'd have to have it in writing as if it was something that we didn't even realize we were being treated special or trying for a special situation. We thought we were just complying with the law as it was.
And can I have one more thing is, because he's an elected official, I mean, we assume that this was public record because he was elected, and so even with the meeting, I would think that when they were saying, well, how do we were asked by our auditor, well, how do we know that you met with him? I'm like, why would I make up meeting with somebody who's the head of the Board of Equalization, who was elected with his staff, and we have, Betty Jo DeColi, who was the head of the California Small Business Association. They were all there. So why would we make this up? And I told her, it's got to be part of his record, but we can't, we don't have the ability, and we don't have attorneys, and we don't have the money to do it, to go, we're going to subpoena elected officials' record. We just, so that's our contention. And the thing is that we feel with this whole thing is we acted in good faith this whole time. And we felt seriously when we were with Jerome Harden, he was pretty amazing. I felt like they acted in good faith too. And we came together and it felt like we're doing the right thing. And so I think where we're coming from is there was nothing that we didn't feel that we were doing that wasn't right. And so anyways.
And a final note is just sheer numbers. If you look at the fine, and if you look at on page 46 of the evidence that was turned in, just look at our net income and look at the money that we've collected. This fine is exorbitant. It's beyond anything we can afford. It's going to be a crusher financially for us. I mean, all you got to do is look at the numbers. We're a small business. We get along. We get by. We work hard. We're both full-time employees in this business, including our son. We love what we do, but we're not getting rich, and we're not trying to get over on the state. We never have. We've complied in every way, shape, and form for the 32 years that we've been in business. Thank you.
Okay, thank you. At this point, I'd like to ask if CETFA has any questions.
So, for the witnesses?
No, thank you.
Okay, I did have one question. Sorry, this doesn't seem to be working. It's fading in and out.
I can hear you fine.
Okay. So I did have one question. So when you were reporting the flat percentage, the 3%, were you collecting sales tax from the customers, or
No.
were you not?
No, it was
It was incorporated in the price.
Okay.
So they were being taxed for everything.
Oh.
or kind of, not really taxed for everything, but it was just like, it was a percentage of the price, the way that they were explained that Starbucks does it, as far as,
We didn't come up with this plan. This wasn't our idea. This was the advice given to us.
Okay. But did you disclose anything to the customers that tax was included in the selling price, or it was just something that you calculated when you figured out?
If people asked us, we would tell them that's how we calculate
yeah.
sales tax.
Once in a while, you have somebody ask. And another thing is, when we came up with even that the percentage is going through that original audit back in, was it 2010, 2011? 2011 is when we went through them. Horton was actually right before the previous year. It was kind of, we met with this woman who audited us, and so we said we had to go back and find out what the percentage would be, like with at Starbucks. So we said it was a standard for the industry standard. So we went back,
Average.
and then she said for us to come up, I kid you not, for us to come up, what do you think the percentage is? So I said, well, 2%. I mean, 2% of our clientele that would be sitting down, you know. And she said, no, that's too low. So we said 5%, and she said that's too high. And we said 3.5. I mean, we just threw out numbers. About my 3 point, she said that sounds good. And that's how they came up with it. So, and it wasn't in writing. It was just this. It was just so weird. But we just, and I think what we felt along the way, and I feel like this tax organization has changed. We've been doing this for 32 years. The way it is now, like every month now, I get an email saying that there's a class, like in Glendale, to help you with taxes. There's a lot more opportunity to get information now, and it seems like it's going the right direction. But for all these years we've been doing it, it was just this very arbitrary number, and we even with the percentage thing, there was nothing in writing. So we just had to take people's word for it. But and it was just, I mean, we couldn't force to have anybody write us anything, you know. And so it was just, that's how it went. Does that make sense?
Thank you. Does anyone on the panel have questions before we move on to CDTFA's presentation?
No questions.
Okay, so at this point, CDTFA may proceed with their opening presentation.
Thank you. Appellant, a California corporation, has operated a coffee and gift shop located in Burbank, California since July 2001. Appellant acknowledges using a blanket 3% taxable ratio of its sales to report its gross receipts. The reporting method used did not take into consideration the proper application of tax with respect to different types of food items sold. The application of tax to the sale of food items turns on the nature of the transaction. For example, whether food was sold hot or cold for consumption on the premises or on a to-go basis. To determine an accurate taxable ratio for food sales, the department examined the daily sales records, accounting of dine-in sales and to-go sales for the period of April 1st, 2016 through May 20th, 2016, 49 days, resulting in a taxable ratio of 15.43%. There also was an observation test conducted on Friday, May 20th, 2016, which yielded a 28.87% ratio. The department used the 15.43% ratio, which it applied to appellant's reported total sales of nearly $2.5 million for the audit period, and determined audited taxable sales of just over $379,000. The audit found a deficiency measure of about $287,000 for unreported taxable sales, resulting in the notice of determination for approximately $25,000 in tax plus interest due. Audit methodology and deficiency measure is not in dispute. Instead, appellant contends they should be relieved of liability because they relied on alleged oral advice given on February 14, 2011 by then BOE board member Horton and his staff to use the 3% figure. They also claim hardship if required to pay the deficiency because they did not collect tax reimbursement. California imposes sales tax on a retailer for its retail sales of tangible personal property measured by gross receipts unless the sale is specifically exempt or excluded from taxation by statute. Section 6596 provides specified instances for relief of taxes or interest for erroneous written advice. There is no lawful basis, however, for relieving tax or interest due to oral advice reportedly made by the agency or board staff. Likewise, the law does not provide equitable relief in this case for hardship. Based on the law and evidence, this appeal should be denied. Thank you.
Did either member of the panel have questions at this point?
No.
I have a couple questions. The appellant mentioned that they used kind of a blanket percentage to figure out their taxable sales. They mentioned that this was what they would refer to as an industry standard. Does CDTFA accept this methodology for taxpayers in this industry?
There is a provision in the audit manual for alternative reporting methods for taxable food sales for certain retailers, but there's not a standard for across the board for any retail seller of food.
Yeah, I didn't ask if there was a blanket standard, but is this one of the methodologies that CDTFA accepts for taxpayers in this industry?
Meaning the
Has it ever
3%
Yeah,
or
3%
or having, there are retailers that are on alternative reporting methods where different percentages may be approved as a plan for reporting. But I'm not sure I understand your question.
I think that answers the question. In other words, there is, CDTFA does accept alternative methods similar to this one, similar to the one that appellants used here. And what's the standard or the method for accepting that kind of alternative methodology?
A taxpayer would have to apply for it and test a representative number of stores, tested based on type. If your store was close to within a mall, or it was by a college campus, or was off by itself, you would have various tests performed during weekends, days, nights, of a representative period of time to make sure you got a sample that was reasonable. Those results would then be analyzed by a member of the department, and then that would be approved. And then for a period of time, taxpayers would then be told they need to do further testing to keep using it past that time. If there was a disagreement, they would do more testing between the two of them, the department and the taxpayer.
Okay, thank you. I apologize for the mic. I can hear everything that you said,
Okay.
so.
I have a loud voice, yes.
Okay.
And Ms. Renati did mention locations. These types of written agreements that we come to with taxpayers require that you have more than one location.
Okay,
have
and this
multiple
procedure was in
locations.
place, sorry, I didn't mean to interrupt, but this procedure was in place during the audit period?
Yes.
Okay. Does the department dispute the fact that this alleged meeting with Mr. Jerome Horton occurred?
We have no information other than the information that's been provided by the taxpayer.
Okay, so it is disputed then?
Well, we do not have Mr. Horton here to indicate what he conveyed or his staff.
Call him up. Bring him in.
Maybe a question for the appellant on this.
Sure.
Were there any other Board of Equalization employees?
Absolutely, he had his entire entourage there. In fact, he had
well,
somebody taking notes.
John Fears was there, and they had somebody taking notes. We didn't have the name. It's John Fears, Jerome Horton, and then Betty Jo Coley. And she's still on the California Small Business Association. She's still on their board.
I don't have that much courage to come up in front of you three gentlemen and tell you that I had a meeting with Jerome Horton, the head of the Board of Equalization, and flat out lie to you about it. I don't have those kind of colonies. I just don't. And it's a little insulting right now. I mean, all we've ever done is try to do the right thing, and it's a little insulting, the implication, even the implication that we'd be lying about that.
I appreciate your honesty. Question for the department on a separate topic. The department raised notions of equity in their brief. What's your position on whether or not this panel can take into consideration notions of equity?
There is no provisions in the law for equity in this case for relief.
If you don't mind, I do have, I'm sorry, don't.
Go ahead.
Just on that issue, in 6593.5 Revenue and Taxation Code, it provides discretionary authority to relieve all or part of the interest imposed by a person under the sales and use tax law when the failure to pay taxes due in whole or in part to an unreasonable error or delay by an employee of the board acting in his or her official capacity. What's CDTFA's position on if this panel finds that that meeting did occur and that advice was given, whether or not we would have authority to relieve interest under that basis?
That it would need to have been written.
That's 6595. 6596 requires written advice, 6593.5 does not require written advice.
That's true, and that is a statutory ability for the panel to make that decision with respect to relief of interest.
So CDTFA doesn't, so if this panel does find this meeting occurred, CDTFA's position would be that we do have statutory authority to relieve interest on that basis.
We may have one moment, please.
Okay.
We do agree that there is provisions in the statute for relief of interest if you find that a board employee made an error. So, I mean, that is a basis for relief.
Okay, thank you. I'm sorry, did you have further questions? I didn't mean to.
That's okay. Just to follow up on that, do you think that applies in this case?
I'm not sure. I'm not sure with the evidence that we know exactly what was said or not said, but I guess that would be for the panel to make a decision as to what employee may have made an error.
Okay. Going back to notions of equity, there is provision in the California Code of Evidence about equity and being able to bring an argument based that's contravened prior advice or action. So, do you have any position on whether equity applies in this case? The equitable stop law.
Are you referring to hardship?
No. Taxpayers' reliance on a meeting or advice given, if we find that such advice was actually given.
Our position is that we look to the sales and use tax law, revenue and taxation code with respect to what type of equity may be statutorily present. I don't know that the evidence code with respect to some type of equity would relieve a taxpayer of tax due. Maybe it has something to do with evidence, but with respect to whether or not tax is due, our position is that the statutes and the regulations are what are required to be followed with respect to any type of equity. There are a few places in the statutes for the revenue taxation code that provide, but apart from that, our position is there are no equitable powers.
Based on what authority?
There's a case out, Standard Oil, that talks about the lack of equitable powers.
Standard Oil doesn't reference equitable estoppel. It talks about issuing a writ.
That is an equitable power, and without equitable powers, without statutory powers, there is not that equitable power. So I would say it's a similar argument.
Okay, thank you. No further questions. Okay, at this time, we'll go on to closing arguments, final remarks. If the parties would like to say anything at this time, we'll start with Helen.
Can I make a correction on something?
Yes.
Okay, about the percentage that we were taking was the 3% that we agreed on, and then I had said 3.5%, and I just want to make sure, so you know, the difference was I actually raised it to 3.5% of what we were paying for the sales tax. Or I did it on my own because I just felt like, just to give a little padding. So we were doing 3%, but then I added to 3.5%. So I just said it incorrectly.
And just a quick clarification on that, I'm not sure, are you disputing the 15.43% that the department came up with?
No, that was just
Or-
originally. I just want to make sure that we were saying 3% and I said 3.5%.
We're not disputing the math. The math is brilliant. These ladies obviously do a great job. They know what they're doing. They're doing their job well. However, I mean, it's very arbitrary. I could do the whole thing and come up with a completely different number. It's a guess.
And we didn't collect it.
It's an estimate, a guess as to what should have or might have or could have happened. The 4-hour observation, 10 a.m. to 2 p.m. If you guys think about that yourself in common sense, right, for a coffee house, when are people going to come and go and not sit down? Before 10 a.m. when they're going to work, and after 2 p.m. when they're leaving and going. She couldn't have picked a time worse for it to be a for here type of service. It's not even close to indicative to what the accurate true estimate is. And here's a final thing, and I mentioned this earlier. We're 75, 80% repeat. I mean, people walk in, they don't even order. We already know what their drink is. They know the law. They know the law better than anybody now. They will say to go and go and sit down because they know they pay less when they say to go. And so even now, what the numbers that they are coming up with right now, I couldn't get those numbers out of the people that come into my store right now if I tried. It's impossible. The only thing I could do is if they went to sit down was then to charge the tax when they're sitting down at the table. Because they know the law better than we do now.
That's more of a future thing, but as far as dealing with what's happened in the past is...
I just take exception to that 20% on her 4-hour observation because that's a ridiculous number. It's not even close. And they use it to justify their 15%, which, like I said, I mean, I just took a statistics class. I'm sure you gentlemen did too. You can make numbers say whatever you want. That's why I don't dispute anything that they wrote there. But I could come up with my own set of numbers.
But I think what we want to say is here on out is that we're aware of how we've moved forward the last several years. We're doing things the way that we have been asked. Since this time, we had the person from the scope audit come through. We're doing everything in good faith. We're asking every person now for here to go. We repeat, like Mark said, we repeat it. So we've moved forward from the original time we met with Jerome and everything that's occurred. So I don't think from here on out there's going to be an issue, but
we don't know though because
we
that's
don't
how
know.
we felt the last time. Like I said, we have nothing today. I couldn't present you gentlemen with anything today in writing of that we're in compliance right now.
we believe we are. You know,
I haven't received anything
Yeah.
in writing. And that continually is the one stickling point that they continue to bring up is in writing. We have nothing in writing.
And the whole way we've presented everything that we've done throughout everything is to getting all the information we can get and doing it the way we're told. And so, anyways, I think that's, we're here in good faith and we're gonna continue doing business in good faith and We hope to
We're just
continue
hoping
doing
for
business
a
in good faith.
reasonable outcome to this. That's all we're asking for, is a
Yes.
reasonable outcome, a fair, reasonable outcome.
Just a quick question for CDTFA. Do you offer anything for the taxpayer, or for taxpayers where you provide written advice to taxpayers? Is there a mechanism that you allow for that?
Yes, it's called a Get It in Writing program, where if you write in via email or in a letter and ask for written advice, it will be given back to you in writing, and you can rely on it based on 6596.
I promise you we'll be doing that. But you gotta understand, we had been in business for 20 years with no issues. Then we were not audited, whatever they call it was, or whatever, fined. We had no idea, this was our first experience, we had no idea we would even have to ask for it to be in writing. We were dealing with the head of the department. We had a meeting. Once again, I just don't know what we would do differently. I don't know how any reasonable person could have expected us in that time to ask for a letter in writing. I wouldn't have done it. Apparently we're not that smart. I don't know. I don't know that anybody would have done it.
And one last thing, I do have a correction. We have been in business since 1988, and that in 2001. That was when we became a corporation, but we were sole proprietor in 1988. So it's been 32 years, and I felt that right. And it'll be 32 years in January. So we've been doing this a long time, and it's not, it's nothing new. It's just we've been just doing everything that we have learned along the way, and
we've made
felt like we
mistakes
did
and we've
correctly.
paid for them. And look, I got no problem paying for my mistakes. This is not a mistake. We did not make a mistake here. There's nothing we would have done differently or could have done differently.
So, thank you.
All right, thank you.
I just have, is the Get It in Writing program available during the audit period or before?
Yes, for at least 30 years since I've been at the board, or
And that-
CDTFA.
And that's the first we've ever heard
Yep.
of it.
Right now.
Yeah.
Thank you.
Okay, at this point, I believe it's CDTFA's opportunity to present closing arguments. If you like, you may proceed.
Thank you. We would just reiterate that the deficiency is not in dispute. There are not issues with the audit, and we submit that there are no basis for relief in this case. And I apologize for my voice and my congestion. I apologize.
Okay, thank you. Is there any other questions from this panel before we conclude this hearing?
The question.
Okay, so this case is submitted on September 18th, 2019, and the record is now closed. Thank you everyone for coming in today. We'll generally try and get an opinion out, written decision out within 100 days from today's date.
Thank you.
All right, thank you.
Thank you for your time.
Thank you. This hearing is now adjourned.
Can you hear me? Before we go on the record, is everybody here for the Martinez Corporation matter?
Yes.
Court reporter, you ready?
Yes, sir.
You guys ready? Before we go on the record, does anyone have any questions? Okay. Let's go on the record then and get started. We are now on the record in the Office of Tax Appeals oral hearing for the appeal of Martinez Steel Corporation, case number 18073411. We are in Los Angeles, California. The date is Wednesday, September 18th, 2019, and the time is approximately 10:48 a.m. My name is Josh Lambert, and I'm the lead administrative law judge for this hearing, and my fellow co-panelists today are Linda Chang and Jeff Njija. Appellant, could you please identify yourselves for the record?
Manny Almeida, representative. Eddie Alamo, Martinez Steel.
CDTFA.
Jerry Noble with CDTFA.
Monica Silva, CDTFA.
And Lisa Renati with CDTFA.
Thank you. This appeal involves one issue which we agreed upon at the pre-hearing conference, whether an adjustment to unreported ex-tax purchases of steel materials subject to use tax is warranted. We also agreed during our pre-hearing conference to admit
evidence appellant's exhibits 1 through 4 and CDTFA's exhibits A through C, and neither party had any objections to the admission of those exhibits. Is that still correct? Thank you, and I hereby admit these exhibits into evidence. Also, we agreed previously that there'd be no witnesses testifying. Is that still correct?
Correct.
Thank you. We discussed that first, appellant would have 15 minutes to talk and give their presentation, and the CDTFA and the judges will be allowed to ask questions. Then CDTFA will make its presentation not to exceed 15 minutes, and the appellant and the judges will then be allowed to ask questions if they wish. After that, the parties can give closing remarks not to exceed 5 minutes. So, appellants, you now have the opportunity to explain your position. You have 15 minutes. Thanks.
Thank you. Martinez Steel is a company that sells steel products, and they are also a contractor. This audit runs through, I believe, the second quarter of 2015, and the one issue that we had with the audit had to do with the timing of when tax should be paid on the ex-tax purchases of materials. During the audit, it was determined by the CDTFA, well at the time, Board of Equalization auditor, that there should be tax paid to the vendors based on the fact that Martinez Steel was not in the business of selling tangible personal property, and therefore they could not issue a resale certificate to its vendors. Obviously, we disagreed with that. Over a period of time, we were able to demonstrate, and as it shows in the exhibits, particularly 1 and 2 that we provided, that there was over $1.5 million in sales of over-the-counter of steel products. At that time, I'm not necessarily sure that during the audit period, the auditor did its due diligence in trying to determine whether there was in fact sales. One thing that was noted during the appeals process was that the auditor kept on referring to sales, retail sales. Ultimately, Martinez Steel not only makes retail sales of steel products, but they also make sales for resale, which, you know, to a certain extent, I think it was a little bit more difficult to try to identify during the process of the audit, because at the end of the day, it was not an issue as it related to the audit. In other words, there were no question of sales for resale during the audit. So we went in and we basically demonstrated by going through and doing an analysis from day one, and the permit was actually secured, I believe, in August of 2010. And over that period of time, Martinez Steel established the methodology and basically the business model that they would have, which was, we're going to be selling steel products, we're going to issue resale certificates to our vendors, and to the extent that we use any of those products in a lump sum contract, we will accrue and pay use tax as we withdraw from inventory, which they did. And ultimately, the issue in the audit was not whether they paid use tax on those products or not. It's when the use tax was paid. And the CDTFA at that time made a decision that, or the Board of Equalization made a decision that, well, you know what, they're not in the business of selling tangible personal property. Therefore, they should not be allowed to issue a resale certificate to their vendors, and therefore they're going to owe tax on the remaining inventory. Of course, we disagreed with this decision, and ultimately we went to the appeals conference and once again presented our exhibits, our position, and clearly there's no statutory authority that says that you are required to pay the tax. The only thing that we were able to find within the statutes, annotations, and rulings is that ultimately, if you're in the business of selling tangible personal property, you can issue resale certificates. There's no specific amount of transactions that are required to have a resale certificate issued to the vendors. All it says is that if you're in the business of selling tangible personal property, you can issue that. The department's position at that time, and here why we're here today, is, well, there isn't a significant amount of over-the-counter sales. And again, they use the term retail. We don't believe retail alone is the term that needs to be used. But again, when you have over $1.5 million, I think 1.6 million plus to be precise, in over-the-counter sales, and you're asking a taxpayer to basically pull all the resale certificates from its vendors and say, okay, now we're gonna pay tax, and now we're gonna take a credit, or we're gonna file a claim for refund on every return thereafter, simply on the basis that you pay tax to the vendor, and now you're basically making sales for resale. Yeah, easy to do a tax paid purchase resold credit if you actually collect sufficient tax to cover what you paid the vendor, but at the end of the day, you're gonna be filing claim for refunds. And ultimately, that was one of our contentions was, okay, so if we have to pay the tax at the end of the audit period, don't we have to file claims for refund for every quarter thereafter until all that inventory has been used up or withdrawn from inventory? So not only do we believe there's no statutory authority, as long as the tax has been paid, we believe the department should be comfortable with that and should have accepted our position. Having said that, we're here today, and obviously we would need, obviously, as far as the decision ultimately being made, if there's tax owed in this particular audit, then now we have to get refunds for all the other periods when the inventory was withdrawn and the use tax was ultimately paid. So in a nutshell, that's really the issue. There's another issue related to use tax within the audit. Items that were purchased from out of state, we have no contention with that, and that is something that taxpayer is comfortable with. But the timing issue, there's plenty of annotations. If you look at Exhibit 4, there's plenty of annotations and rulings that clearly demonstrate that it's more subjective than anything else. And the reality is that contractors out there, they do both. And if they have over-the-counter sales, they should have the ability to issue resale certificates, particularly if it makes it easier for them to comply and the state winds up getting all of their sales in or use tax associated with those purchases. So that's, in a nutshell, that's our position. And we feel very strongly that if the tax has been paid, the decision should be rendered for the taxpayer.
Thank you, Mr. Almeida.
Thank you.
So UTFA, you have 15 minutes to make your presentation.
In this appeal, there is no dispute that appellant is a construction contractor that furnished and installed steel rebar in California under lump sum construction contracts. In addition, appellant also makes sales of steel without installation, either at retail or as sales for resale to other retailers. During the liability period, appellant purchased $18,374,604 worth of steel without paying tax, either by issuing resale certificates to its vendors or purchasing the property from out of state. During the liability period, appellant reported a taxable measure of $15,534,190, representing $15,516,800 of steel consumed in the performance of construction contracts. And according to documents provided by appellant, it sold either at retail or as sales for retail $17,320 of steel. The deficiency measure established during the audit of $2.8 million represents the difference between the taxable measure appellant reported on its sales and use tax returns and the steel it purchased without paying tax. Under Regulation 1521, Subdivision B2A1, construction contractors are consumers of materials they furnish and install in the performance of a construction contract, and either sales or use tax applies to the contractor's purchases of materials. Furthermore, a construction contractor may not purchase materials for resale unless they are also in the business of selling materials. Pursuant to Regulation 1668, Subdivision G, when a retailer improperly issues a resale certificate for property that is not intended to be resold, the tax becomes due at the time of purchase. In addition, the Department's Audit Manual, Section 1206.10, provides that when a construction contractor purchases material for consumption without paying tax, the tax becomes due at the time of purchase, not at the point at which materials are withdrawn from inventory for use by the contractor. According to Sales and Use Tax Annotations 190.0161, in 190.0208, a construction contractor may issue a resale certificate when purchasing materials in fungible lots, some of which will be resold and some of which will be consumed in the performance of construction contracts, but only when a significant portion of the material is intended to be and is actually resold. If at the time of purchase, the contractor knows that certain materials will be consumed in the performance of a construction contract, the contractor may not issue a resale certificate with respect to those materials, and the sale is subject to tax. Essentially, even when a contractor also sells materials, it can only make an entire purchase of materials without paying tax when it intends to resell most of the materials and it does not know what amount will be consumed. As applied to this appeal, the evidence establishes that appellant had retail sales of $17,320, whereas appellant consumed steel totaling $15,516,000. This means that appellant resold less than 1% of the total materials it withdrew from its resale inventory during the liability period. That appellant only resold less than 1% of the steel it purchased during the liability period strongly indicates that appellant did not intend to resell a significant portion of the steel it purchased. Further, according to Schedule 12A-1 of the audit work papers, the Department's Exhibit C, appellant purchased approximately $9.8 million of steel in 2014 and reported a taxable measure of approximately $5.5 million. However, according to appellant's Exhibit 1, it recorded retail sales of steel of only $2,978 during the same quarter. Appellant could not have reasonably intended to resell a significant portion of over $9 million in steel purchases based on these amounts. Instead, the evidence establishes that appellants purchased the materials for its own consumption. Therefore, under Regulation 1668, Subdivision G, appellant's purchases of steel with resale certificates and without payment of tax at the time of purchase were improper, and appellant is liable for use tax at the time it purchased the steel. None of the authorities relied upon by appellant provide that a retailer can purchase all tangible personal property for resale without paying tax. Rather, the authorities provide that you must intend to resell a significant portion of a commingled lot of goods. In addition, with respect to appellant's arguments regarding sales of steel prior to the liability period, the journal entries appellant provided as Exhibit 2 only show appellant's alleged over-the-counter sales of steel, either sales for resale or retail sales. The journal entries do not indicate the total amounts of steel purchases during that time, thus there is no way to determine whether significant portions of the steel appellant purchased were resold rather than consumed. Furthermore, considering appellant sold less than 1% of the material it withdrew from inventory and consumed the remainder, appellant sales prior to this liability period still would not establish that it intended to resell significant portions of the steel it purchased during the period issued. Further, according to appellant's Exhibit 1, the bulk of its over-the-counter sales of steel, approximately $1.2 million, occurred in the fourth quarter of 2011, and according to appellant's sales journal for that quarter attached as Exhibit 2, all the sales were coded to the same job number in the county of San Bernardino. This indicates that the bulk of appellant's over-the-counter sales in prior periods were to the same customer, and likely an outlier and not a repeated pattern of over-the-counter sales. Likewise, appellant sales after the liability period also do not establish that it intended to resell significant portions of the steel it purchased during the periods it issued. There is simply no evidence that establishes that appellant resold significant amounts of steel. In fact, the evidence shows the opposite. Appellant consumed a very significant amount of the steel it purchased. With respect to the invoices showing that appellant collected tax reimbursement from its retail sales of steel after this liability period, and appellant's assertion that it reported use tax on steel it consumed after the liability period, the claim for refund is pending. That claim for refund is not part of this appeal. However, any overpayment of tax that can be verified during these periods will be applied. Accordingly, there is no evidence or legal authority to establish that the audited deficiency measure is not valid, and this appeal should be denied.
Thank you. Anyone, do you have any questions for CDTFA?
Well, I think speculation on the $1.2 million that, that is not accurate. Again, during the audit period, all of these things were addressed, but because those particular periods, and again, you have to understand, when the taxpayer establishes a pattern of, okay, here's what we're going to do, and we're going to start at least try to get some business any which way we can. And they establish that whether it's one customer or 10 customers are gonna buy the steel, and there is a worthwhile business decision to be made, that's gonna happen. So again, with respect to that comment about the outlier, the whole thing, it's, that's purely speculation and not factual. But at the end of the day, there is no statutory authority that gives you a specific amount that's significant. I mean, obviously, when you establish a pattern with vendors, if you've been through enough sales tax audits over the years and you see where resale certificates are being issued to vendors, and ultimately somebody is asked to pull those resale certificates from the vendors and now start basically paying tax, the compliance level of trying to fix that and resolve that, particularly, like I said, in a situation where you're going to be filing claims for refunds for any subsequent over-the-counter sales which you pay tax on cost, and that is an absolute compliance nightmare, not only for the taxpayer, but simply for the department that has to go back and forth, and ultimately what they normally tend to say is, hey, look, if you're going to continue to file claims for refund, maybe you should change your billing methodology. But at the end of the day, there's no statutory authority that says that you have to have a certain percentage. There's no particular amount in place. And again, if you look at the exhibits, or the annotations and rulings in Exhibit 4, there is numerous transactions or examples of rulings and transactions where it happens, where you have resale certificates issued to these vendors. You can't just all of a sudden pull resale certificates and say, okay, well, don't tax me on those. And again, there's fungible goods. I mean, Martinez Steel maintain inventory, and to the extent that they could sell that inventory over the counter, they would certainly do so. So, otherwise we wouldn't be talking about it. Otherwise, they would be buying the product and subsequently having it shipped directly to the job site. So,
Okay, thank you.
you're welcome.
Judges, do you have any questions for CDTFA, do you have any questions for appellant?
We don't have any questions, thank you.
Judges, any more questions? Appellant, do you want to give a final closing remark?
Yeah, and bottom line, at the end of the day, the tax has been paid, and it's been paid long ago. Probably, if anything remained, it was probably through the fourth quarter of 2015, and they will continue to do, as we've heard this morning, they will continue to do things accordingly until there is a written decision that requires them to change it, because ultimately they're paying the tax. If we have an issue where they are not paying the tax, or there's other things associated with buying tangible personal property from vendors and not paying it, I can understand it. But here we are 4 years later, and this tax has been long gone, it's been paid. We're going to basically, this decision will basically potentially establish a whole different ballgame for them in trying to go back and comply with having to provide all these records to prove the refunds and so on and so on. So hopefully we don't have to do that, but
Thank you.
thank you.
CDTFA, do you have a closing remark?
Yeah, we would just reiterate that in this case, appellant's over-the-counter sales of steel represented less than 1% of the materials it purchased without paying tax. This very low percentage of sales of steel indicates that appellant did not intend to resell a significant portion of the steel it purchased. In other words, it really indicates that appellant was not in the business of selling steel. Accordingly, appellant is liable for use tax from the date of purchase, and this appeal should be denied. Thank you.
Thank you. I'm going to close the record and conclude the hearing, so thanks to both parties for coming. Following the hearing, me and my co-panelists will discuss the evidence and argument, and we'll issue a written opinion within 100 days. Thank you. The hearing is now closed.
Thank you so much.